Susan, it's great to see you. Thank you so much for sitting down with me.
Absolutely. I'm delighted to be here this morning.
It's great to have you in Washington, too.
Yeah, I'd love to come visit Washington, absolutely.
The president has paused steep reciprocal tariffs for 90 days, but he has retained the universal 10% tariff. At the same time, he ratcheted up tariffs on China to 145%. This morning, China is hitting back. What concerns you most about this current environment as tariffs stand right now, and as well as the impact on the economy?
Yeah, well, the higher the increase in tariffs and the more broad-based, of course, the larger the impact would be on our economy, on inflation, on growth. But as I think about things, my starting point really is that we came into the first quarter of this year with economic conditions that were quite solid overall, in terms of labor markets, in terms of inflation that was slowly, perhaps unevenly, moving back down. And so in that context, the tariff increases that have been announced and the uncertainty in terms of tariff, but also other policies, certainly does influence the outlook and also clouds it. And I think it's important to recognize that up front. So, my outlook would be for higher tariffs higher inflation, throughout this year with slower growth. And, the uncertainty, again, does cloud the outlook, and there are a number of other things to watch, from the financial market volatility, while markets continue to function well, to possible impacts on inflation expectations, which could also be a concern. So those are some of the things that I'm quite focused on as I look forward for the U.S. economy.
Do you believe we are in a full-blown trade war with China right now? And what are the implications there, given how high tariffs are on the U.S. and now from China's side as well? Do you see the U.S. economy decoupling from China? And what are the implications in terms of supply chains, product availability, and pricing in this country?
Yeah, so there are a lot of pieces to that. Certainly the tariffs that have been announced on our imports from China and the announcements that China made are extremely significant, and that is concerning in terms of potential impacts. The integration of U.S. supply chains and production processes has evolved over many, many years, and China has been a really integral part of that. And so, looking forward, the implications in terms of costs and efficiencies are, significant. And when I talk to firms in the First District, they're obviously very focused on that. Many firms, particularly in apparel, in some types of electronics, had shifted some processes away from China, for example, to other countries in Asia relative to where they were 6 to 8 years ago. At the same time, significant investments like that are difficult to make in periods of extreme uncertainty, especially if, as a firm, you have recently made major adjustments. So there are a variety of things to recognize looking forward, and what I hear is really a pervasive wait-and-see approach as firms consider how to react to an environment that is highly uncertain and with the tariffs quite elevated. 10% overall is very high. That is a large increase. And then, of course, the ones on China are much more substantial.
You mentioned that you expect slower growth this year. The Fed has penciled in 1.7% for GDP. But given the tit for tat that we're seeing now, specifically with China, are the odds growing for a recession? Are you growing more concerned that we could see a contraction in growth later this year?
Well, as I mentioned at the outset, the higher the tariffs are, the more the potential slowdown in growth, as well as elevation in inflation that one would expect. Certainly there are more adverse scenarios that I wouldn't rule out, but my own kind of modal scenario is one of slower growth, not a significant downturn, but there are a number of factors to watch in that context more broadly. In particular, the kind of wait and see approach that I mentioned. I think the financial market movements are something to stay focused on as well. And so my current outlook, again, is not the more adverse one, but I wouldn't rule it out.
In terms of the outlook for inflation, we stand at 2.8% right now on inflation. And you mentioned in your speech last night that if we had an effective tariff rate of just over 10%, then we could see inflation well above 3% this year. However, given that the tariff on China is 145%, JP Morgan's estimating that the effective rate could be as high as north of 25%, so more than double. So could we be looking at inflation of over 5% this year, or as high as what we saw during the pandemic?
Well, so there are a number of factors of that. I mean, as I mentioned, the higher they are, the bigger the impact would be, certainly. Boston Fed staff is assessing and estimating what the ranges would be. And in that context, it's really important to take into account the fact that tariffs are applied not just to final goods that are imported in, but also to imported intermediates, which are about 44% or so of those imports. Are much more broad-based than many people realize. And so the breadth of sectors that would be impacted is quite large. And so the estimates that I mentioned when I was at Georgetown yesterday do take all of those factors into account. How long they would take to impact inflation is hard to tell, because there are a number of factors, right? Even if the tariff amount, the level of tariffs don't keep moving, how long it takes for firms to adjust to pass through. What I hear when I talk to firms, what we've heard in surveys that we do, is that that's likely to take a year or more, perhaps as long as 2 years. And so the persistence and how much of the increase we would see in 2025 versus perhaps longer than that is a little hard to assess in that standpoint. But I would expect inflation rates well over 3% for 2025 in the current context.
To your point then, you and your colleagues have stressed keeping long-term inflation expectations in check. And some of your colleagues have said that that raises the bar on rate cuts for later this year. Do you share that assessment? Does that put off the notion of rate cuts?
I do think it's a really important consideration. One of the very important assets that the Federal Reserve has is its credibility, and that is manifested in anchored longer-term inflation expectations. One of the key reasons that the disinflation was not associated with larger downturns that we've seen so far was associated with that anchoring. And so it's something I watch very closely going forward. Many indicators of longer-term inflation expectations are still in the range that we would hope to see, but some of them have been more elevated recently. And so that very much would factor into my own view and how much confidence I would have in inflation moving down over the longer term. That's what I would need to be looking at to consider additional normalization of policy rates.
So then do you see a scenario where you end up holding rates steady for the entire year?
So I think at this point, my expectation is that we are likely to have to hold for longer than I had before. It may still be appropriate to begin normalizing towards the end of the year, but I would need to see that confidence, and anchored inflation expectations at the longer term would be a key part of that determination on my part.
Susan, you mentioned that it could take a couple of years for inflation from tariffs to really filter through our economy. We know that there are going to be tariffs on intermediate goods filtering through our supply chains. How are you thinking about the prolonged effects on inflation?
Yeah, so typically if you have a tariff put in place and it's maintained over the longer term, I would see that as causing a change in price levels, and it's the adjustment to that new price level that is what gives you the inflation. But if it takes some time for that adjustment to happen, then the persistence of the inflation is going to last for longer. And there are a number of factors in that in terms of how firms do the pass-through, how various other kinds of adjustments are made. But as I've talked to both large and small employers and firms in my district and looked at some of the results of surveys of small businesses, what I'm hearing and we're seeing in those surveys is that many firms expect it to take longer to really factor through what what their own pricing looks like. And so I am rethinking my initial view that it may only take a couple of months if the tariffs were to be kept at a certain level. And then, of course, we know the tariffs have been evolving, and so that can have an impact as well in terms of the persistence.
So do you think that inflation could not just increase for this year, but persist then through 2026?
So, I would, it's early in the year, and so if it takes a year plus, my kind of modal outlook, again, don't know how to factor in continued changes in the tariffs. Would that be that into 2026 we would start to see inflation begin to moderate? At the same time, one of the things I would be looking carefully at was not seeing expectations become unmoored, which would have broader implications for price setting, and that would be more persistent, and that's something that I would take very seriously as I think about policy.
Do you worry about stagflation?
Well, I certainly am concerned about both sides of our mandate. And as I mentioned, my expectation is slower growth combined with higher inflation. And we'd be looking at both sides of that. I think that can be a complicated challenge for policy because, with slower growth, if growth slows dramatically, you would want to ease, but with higher elevated inflation, it's really important to maintain the restrictive posture. So how to balance those is certainly something that I think about and is something that we would have to navigate as the economic conditions became clearer.
You mentioned you're watching the financial markets closely, and the Treasury market has been on a wild ride over the past week and a half. What are your takeaways from that? Are there implications for your balance sheet and how that's being managed? Obviously, the runoff has now been slowed down. Could we see changes on account of that? And what would it take for you to intervene in the Treasury market?
Let me say a couple of things about that. Maybe I would start by saying that the markets are continuing to function well. Liquidity has been maintained. That's something, of course, we're watching very carefully, and we do have tools to intervene if there were concerns in terms of market function or in terms of liquidity, and we are absolutely prepared to move as appropriate in those circumstances. We did slow the pace of runoff recently, and I think that positions us well to continue normalizing the balance sheet in a steady way that does not contribute to some of the market changes that we've seen. But again, it's something we'll continue to watch carefully. But I think we're well positioned in that context as we are in terms of the policy stance for monetary policy.
Do you worry that the tariffs could somewhat sully the reputation of the U.S. and hurt foreign demand for U.S. Treasuries? That's been a concern in markets this week.
So there are a variety of things that could influence, financial flows and demands, and we continue to try to assess how things are evolving. And at this point, it's very difficult to parse out particular pieces of what impacts some of these many considerations could have.
And before we wrap up, you've said that you need to see inflation start to come down before you would normalize policy. The markets are factoring in a rate cut in June. Too soon?
Yep. So what I would say is I think we're well positioned. We need to look at both sides of the mandate. I would be looking for more confidence that we were back on that disinflation trajectory, of course, unless we are in a more adverse context. Not my baseline. Again, there is quite a bit of strength in some of the underlying fundamentals of the economy, and policy is well positioned to react as appropriate.